Oil prices are spiking. A new war is expanding. Your money may already be at risk. Over the past 48 hours, witness crude oil prices surge, dramatically following direct military conflict between Iran and Israel, two of the most geopolitically sensitive actors in the Middle East, now with the United States officially involved. This situation has escalated far beyond a local confrontation. What was once a regional flashpoint is rapidly becoming a global catalyst for financial instability. But while most people are glued to headlines or distracted by noise, the financial elite, the smart money, are already moving. Behind closed doors, capital is being reallocated, hedge strategies deployed, and portfolios repositioned for the chaos ahead. Because moments like this don't just change the map, they rewrite the rules of wealth. War has always been a mechanism of wealth transfer. Resources shift, prices jump, economies recalibrate. Now those who act early usually emerge stronger. If you care about protecting your wealth in uncertain times, this channel is for you. Subscribe now to stay ahead of the headlines, the markets, and the crises. We don't just analyze, we prepare. Because in a world driven by chaos, those who understand early protect better. To understand how capital moves during times of war, we need to look at both the events and the reactions they provoke in global markets. The geopolitical context: for years, tensions between Iran and Israel have simmered. And now, with missile exchanges, direct strikes, and public military declarations, we're entering an entirely different phase. The United States has stepped in militarily, shifting this from a regional skirmish to a conflict with global implications. One of the key flashpoints is the Strait of Hormuz, a narrow waterway through which roughly 20% of the world's crude oil passes daily. Any disruption, their blockade, sabotage, or naval confrontation would immediately shock global energy supply and pricing. This is why oil traders are moving fast. They understand the stakes. What we're witnessing is not simply a regional war. It's a financial and economic trigger point. Global markets are built on the assumption of relative geopolitical stability. That illusion has just been shattered. The oil market's violent reaction in the past 24 hours. Brent crude and WTI futures have surged dramatically. We're not talking about speculative pumps. This is institutional money hedging real risk. Companies like ExxonMobil and Occidental Petroleum Oxy have seen strong upward momentum. These aren't random stock movements. They're the first wave of capital repositioning toward energy resilience. ETFs such as XLE, VDE, and IXC focused on the energy sector gaining volume and traction. Large institutions are increasing exposure to commodities, particularly energy, not for speculation, for strategic positioning. Whenever oil surges like this during a geopolitical crisis, it's not just about supply, it's a signal. The world is entering a new phase of volatility, and energy is once again king. The risks to your money: higher oil prices mean more expensive transportation, manufacturing, and eventually consumer goods. This leads to inflation spikes, even in countries that are geographically distant from the conflict. As energy prices rise, the cost of nearly everything follows. The US dollar may strengthen in the short term due to its safe haven status. But if the conflict drags on, economic uncertainty could erode that strength quickly, urging markets, especially those dependent on energy imports, are particularly vulnerable. Currency depreciation, rising fuel prices, and capital flight are real possibilities. This is not theoretical, it's historical. Every major Middle Eastern conflict in the past 50 years has led to inflationary shocks across the globe. When the average consumer pays more, portfolios that aren't adjusted for energy volatility get hammered. What the big players are doing: institutional investors are not waiting for confirmation. They're reading the risk early and moving fast. BlackRock, Bridgewater, and other hedge funds are increasing positions in oil, energy infrastructure, and precious metals. They're reallocating from vulnerable growth stocks and tech into real assets, commodities that hold value in conflict. Companies involved in exploration, drilling, and refining are attracting interest. ExxonMobil, Chevron, CVX, and Schlumberger SLB are seen as strategic defensive assets, not just profit plays. Short-term U.S. Treasury bonds are still viewed as safe havens, but even those are being used in rotation temporary parking lots. For cash, while new energy positions are established, this isn't panic. It's preparation, tactical protection, and strategic opportunity. If you're an individual investor, this is the moment to stop reacting emotionally and start thinking tactically. For protection, consider exposure to energy XOMOXYXLEIXC. Precious metals, like gold and silver, GLD, PHYS. SLV Diversified Commodity Funds DBC. It's holding cash in strong currencies or short-term U.S. Treasuries for opportunity. Consider high-dividend energy stocks that perform well in inflationary and volatile conditions. Energy sector options with extreme caution. Hedge positions through ETFs or futures if you're an advanced trader. Above all, the first goal is protection. Only after that should you think about profit. Possible scenarios from here. Let's lay out 3 possible paths this conflict could take and what each means for your money. Scenario 1: containment. The conflict remains regional and controlled. Oil prices stabilize after a short spike. Volatility persists, but inflation is somewhat contained. Markets breathe temporarily. Scenario 2: escalation. Iran blocks the Strait of Hormuz. US and Israeli responses intensify. Oil hits $120 or more. Inflation returns aggressively. Central banks are caught off guard. Risk assets fall. Scenario 3: regional collapse. Additional Middle Eastern nations become involved. Proxies activate. Global energy trade is disrupted. Supply chains freeze. Capital flees risk assets. A full economic shockwave hits emerging and developed markets alike. Each scenario brings different challenges, but all demand one thing: preparation. This war may feel far away from your daily life, but its consequences are already arriving at the gas pump, in commodity markets, in bond yields, and in your portfolio. You don't need to panic, but you do need to act. While most people scroll headlines, the wealthy are moving fast, hedging exposure, locking in oil profits, buying gold, and repositioning for what's coming next. They're not waiting. You shouldn't. Either subscribe and prepare. This war won't wait, and neither should your strategy. This isn't fear. This is financial survival. Because those who understand early protect better.